Another point for defense on income, Ben, is optimization of tax. So by that, I mean your income can stretch further if, for example, you're a property investor and you need to use less of your income to actually
Yep.
fund any shortfall, right? So that obviously comes down to making sure you get a depreciation schedule, but also the nuance, Ben, of having an accountant who is, we talk a lot about an investment savvy mortgage broker. You
Yeah.
want a property savvy accountant. And the reason you want that too, Ben, is as a defense conversation, is because there's plenty of accountants who do amazing work across the economy, but some of them choose to be specialists in a particular lane. Well, it would make sense that you find someone that's a specialist in the lane of property, because if they can find a maximum way to legally claim, optimize, and legally maximize the amount of claims that you can, in the traditional sense that the negative gearing system works in this country, it means
Yeah.
that particularly non-cash deductions like amortization of loans and non-cash deductions that you find in depreciation, all those non-cash opportunities to maximize then improve the amount of loss that you make in the accumulation phase, which is fine because at some point we will get to the break-even point, Ben, but during the
Yeah.
accumulation phase, you maximize and optimize, which means that you can get more cents back for every dollar that you pay in tax, which will obviously underpin the amount of cash flow that you have in your house, which is why we've put it here as a defense strategy under income, because it's important that we have our income going towards the things that we want the most, whilst also optimizing what we can do here in terms of our legally claimed deductions, Ben.
It's money that's legally claimable, to your point, Bryce. So why not take advantage of it and add it to your cash flow pool and income pool? Because if you don't, um, it's basically just leaving money on the table.
Mm-hmm.
So ultimately we do highly encourage you to take advantage of those opportunities. And then finally, Bryce, income protection. So when you're starting out on this journey of income building, trapping surplus to build wealth over time, it's really important to understand that you're the asset. You, as the individual who's producing that income until such time as the wealth base and the capital that you have built up over time then supplements you with income that's coming off that capital base, you're it. So, you insure your car, you insure your health and well-being. You're going to produce over $7 million, typical household working 40 years, at least $7 million of income. But if you get injured or hurt or whatever, you're not going to be able to produce anything potentially for a period of time. And then to Bryce's point about the house of cards, I'll tell you what, it's not built on good foundations then. So you've got to make sure that you factor that into your calculations. So don't think of it as a cost though. Think of it as an investment into an asset that you never ever really want to call on, because if you are obviously seriously injured or suffering from a life-threatening illness, those income protection policies are worth their weight in gold. It will absolutely, in most cases, change your outlook in terms of the wealth accumulation story. But guess what? Wealth is nothing if you don't have your life. So your health is your wealth. So that's the first thing that we want to protect. So I really do think it's important to make sure that when you're doing your models and you're understanding and doing your budgeting, that you have some type of income protection or life trauma or TPD cover as part of that.
Ben, it's worth pointing out that a lot of banks look for this when they are dealing with sophisticated investors. So, for example, if you've got your own home and then you go and buy an investment property, great. But as soon as you start wanting to build and they can see that you're building out a portfolio of property, part of the bank's risk assessment is looking at you to go, all right, you're starting to take on more than the average optimized debt here. And so we want to have some evidence to suggest that, okay, you feel pretty confident about all the things that we talked about before, your job security and you're increasing your skills and you've got a buffer in place and you're maximizing the tax. But from the bank's perspective, they actually want to protect that downside too. So
Yep.
part of you getting more sophisticated in the amount of borrowing, just know that the banks are actually looking at that stuff and they're going, do you have, we're going to talk about some more insurance in the next column shortly, Ben, or the
Yeah.
next circle, but just for this circle, they're going
Yeah.
to look at that. Because they were going to go, if something happens to you, we want to make sure we're okay.
Yeah, absolutely. And I think that's why it's an asset. You should never look at it as a net expense, because ultimately it's an asset, again, you hopefully never want to call on. And it's a bit like when you're paying off a loan of a property, it's appreciating in value. When you're paying off income protection insurance, it can appreciate if you increase the level of income as your income grows. It's usually 70% of the income that it will replace. So, but you got to keep moving that up. So it's a bit like paying the fee for having that protection as part of that. So I think it's really important. If you want to, coming back to the unforgotten pillar, the unforgotten principle of defence, this is why we always want to remind people of it.